Hello. I'd like to talk to you today about owner financing. What is owner financing? Owner financing is one of our investor techniques that we've used successfully. Owner financing is when all or part of the purchase price, less the buyer's down payment, is carried by the seller. The seller is providing owner financing. It doesn't matter if the property has an existing loan, except to the extent that the existing lender might accelerate the loan upon sale due to an alienation clause. Instead of going to the bank, the buyer gives a financing instrument to the seller as evidence of the loan and makes payments directly to the seller. If the property is free and clear, meaning the seller has clear title without any loans, the seller might agree to carry all the financing. In that instance, the buyer and seller agree upon an interest rate, monthly payment amount, and term of the loan, and the buyer pays the seller for the seller's equity on an installment basis. The security instrument is generally recorded in the public records, which protects both parties. Let's talk about some types of owner financing. Most purchase money transactions are negotiable. Sellers and buyers are free to negotiate the terms of the owner financing, subject to usury laws and other state-specific regulations. While there is no standard down payment required, many sellers want a sufficient down payment to protect their equity. Down payments can vary from little to 30% or more. Sellers feel their equity is safeguarded by the buyer's down payment because buyers are less likely to go into foreclosure if they've invested a lot of money up front. Some variations of owner financing include land contracts. Land contracts do not pass legal title to the buyer, but give buyer equitable title. The buyer makes payments to the seller for a certain period of time. Upon final payment or a refinance, the buyer receives the deed at that time. Another is promissory notes and mortgages. Sellers can carry the mortgage for the entire balance of the purchase price, less the down payment, which may include an underlying loan. This type of financing is called an all-inclusive mortgage or an all-inclusive deed of trust. In some parts of the country it's known as chattel mortgage. The seller receives an override of interest on the underlying loan. A seller may also carry a junior mortgage, in which case the buyer would take title subject to the existing loan or obtain a new first mortgage. The buyer receives a deed and gives the seller a second mortgage for the balance of the purchase price, less the down payment and the first mortgage amount. Lease purchase agreements. This is another way. Selling on a lease purchase agreement means the seller is giving the buyer equitable title and leasing the property to the buyer. Upon fulfillment of the lease purchase agreement, the buyer receives title and it typically obtains a loan to pay the seller after receiving credit for all or part of the rental payments toward the purchase price. One needs to be careful when using lease option agreements in the state of Texas and in other states, as they are now considered illegal in many courts. Let's talk about owner financing benefits to the home buyer. In today's volatile competitive market where it's difficult to get money, there's little or no qualifying. Even if the seller demands a credit report on the buyer, the seller's interpretation of the buyer's qualifications are typically less stringent and more flexible than those imposed by conventional lenders. Tailored financing. Unlike conventional loans, sellers and buyers can choose from a variety of payment options, such as interest only, fixed rate amortization, less than interest, or balloon payment. Payments can mix and match. Interest rates can adjust periodically or remain at one rate for the entire term of the loan. Down payment flexibility is another benefit. Down payments are negotiable. If a seller wants a larger down payment than a buyer possesses, sometimes sellers will let a buyer make periodic lump sum payments toward the down payment. Lower closing costs. Without an institutional lender, there are no loan or discount points to pay. No origination fees, processing fees, administration fees, or any other assorted miscellaneous fees that lenders routinely charge. This is very typical, as many of you know, trying to get financing for your investments these days. This will save money on the buyer's closing costs. Faster possession is another benefit. Because buyers and sellers aren't waiting on a lender to process the financing, buyers can close faster and get a buyer possession earlier over a conventional loan transaction. What are some of the benefits to the sellers using owner financing? A higher sales price. Because the seller is offering owner financing, the seller may be in a position to command full price or higher. Tax breaks. The seller might pay less taxes on an installment sale, reporting only the income received in each calendar year. Monthly income. Payments from a buyer increase the seller's monthly cash flow, resulting in spendable income. And higher interest rates. Owner financing typically can carry a higher rate of interest than the seller might receive in a money market account or other low-risk type of investment. Shorter listing times. Owner financing attracts a different set of buyers. If a property is not selling under conventional methods, offering owner financing is one way to stand out from the sea of inventory and move a hard-to-sell property that otherwise might not sell. Please note that what I have said is informational only and not legal or financial advice. You need to consult with an attorney and your financial advisor to get professional advice in this regard. Thanks, and have a wonderful day.